So appraisers, we normally follow a set of standards, or if you're used to legal talk, a standard of care. There are a number of sets of standards in use around the globe. The biggest and most well-known is probably the Uniform Standards of Professional Appraisal Practice, because it's been around the longest. It's used in the United States and a few other places, like Australia is a big place. Also, the International Valuation Standards. It's a little younger, but it's already in use in 90 countries around the world, largely in Europe, all of Europe, North America, Australia, Asia, South America, even parts of Africa. And then you have the Red Book by the Royal Institution of Chartered Surveyors, and we don't need to get into that because it incorporates the International Valuation Standards by reference. So one of the things that both USPAP and IVS require in every appraisal is disclosure of the intended use or the purpose of the appraisal. All right. In USPAP, it shows up in the definition, so I added the underline and the italics so you could see that. And then in IVS, you see it right away in Part 101, so right at the beginning of the document. So why is the intended use important? Why should you care about it? Well, as standards go, the most important reason is the one that supports the mission of standards as a whole globally, which is public trust. Why do you have standards? So that the public trusts that what you're doing is in line with what everyone else is doing. And the most important thing for public trust in the case of intended use is the credibility of the appraisal. There are three, however, very practical reasons as well. The first two practical reasons are delineated in USPAP's advisory opinions, which is the part at the back of the book which nobody wants to read, but you better, because that's where the good stuff is. And that's determining the scope of work and the level of detail that need to be written into the report. But what's really important is that the intended use determines the premise of value, or the definition of value, or the standard of value. All right, that's it. That's the backdrop completed. Now we can go to why I came here. Why did I ask Al for 20 minutes on the podium today? Because I've noticed a growing trend, right? And that is to identify the intended use to your appraiser as portfolio review. Now, portfolio review is great. That's fine and dandy. You should use it for internal reviews. You can use it for annual reports, for 10K filings for your public company. That purpose uses some market value or liquidation value, something to do with the market. However, I have recently discovered, since coming back to the appraisal industry, that this purpose is being used for impairment testing. Bad idea. Bad idea. Like, go to jail, bad idea. Okay? I'm going to quote Chris Mercer to answer that. Now, Chris has written many books in the valuation field. He's been inducted into the ASA's College of Fellows. He's a certified financial analyst. He's a genius, okay? So he's worth quoting. He said, every valuation assignment begins with the determination of the appropriate definition or standard of value. Provides guidance about how value is determined, from what perspective. The appropriate standard of value for most financial reporting valuation assignments, including impairment testing, is fair value as defined in ASC 820. And I will throw in there that for those of you not in the US, that is IFRS 13. Fair value is different than other standards of value, such as fair market value or the legally defined statutory fair value. Whether your company reports under US GAAP or under international financial reporting standards, the impairment test requires the use of fair value as specified in IFRS 13 or ASC 820. The definition is the same in both sets of accounting standards. The price that would be paid to received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. That definition is the same in both sets of standards, accounting standards. Both sets of standards are long and robust, with plenty of extra instructions for fair value in slightly different words, but with the same intent. First, fair value assumes a sufficient marketing period, which means it is not a forced liquidation or a distress sale, even though it does reflect prevailing market conditions. Second, fair value is an exit price. That means the price that would be received to sell the asset, rather than the price that would be paid to acquire an asset. So different add-ons and options go into an exit price than go into an entry price. Third, fair value requires the use of the principal market for the asset. The principal market is defined as the market in which the reporting entity would sell the asset with the greatest volume and level of activity. That is not necessarily the most advantageous market for any given asset, right? The only time that you're permitted to use most advantageous market is when there's no clear principal market. You got to stick where the trades really happen. Overall, fair value measurements have to rely on the highest level of inputs available. There are 3 tiers or levels of input. Tier 1 is observable direct inputs for identical assets in an active market. Tier 2 is observable indirect inputs, which means a similar asset or a slightly less active marketplace. And Tier 3 is unobservable inputs, which as appraisers we have a little nasty phrase for called trend and bend. The helicopter market is an active market, or for some models, possibly a less active market. Appraisers should not need to use unobservable inputs, which is typically management input or external peripheral research, unless they're doing an income approach, or in the case of very unusual models. Have I used them? Yes, I have. I remember doing an IRS Form 8283 appraisal, which for the rest of the room means a non-cash charitable contribution for an estate tax filing in the States. There were 6 historic airframes that were completely trashed and sitting in this guy's backyard, but they were being donated to a museum because they were historically important. Some of them had not had an active market or even a type certificate in decades, like the Piasecki PV-14. Those definitely required a lot of unobservable inputs. Drag myself back to the point. I don't want to rehash this until you're sick of me, and I'm going to make up some of the time here so that we can get out of here early tonight. But I do want to make sure you go home with the distinct knowledge that you cannot tell your appraiser that your intended use is portfolio review and then turn around and use the appraisal for an impairment test. What does that mean for you? What do you need to change when you're requesting an appraisal? What do you do when you call me? First of all, tell us what you're doing with the appraisal. In detail, if your appraiser follows any kind of standards at all anywhere in the world, there are confidentiality sections in there with which we must abide. If you're still nervous, have us sign an NDA. We do that all the time, okay? It's very common. I don't want to go to jail. You don't want to go to jail. So tell your appraiser if you want an appraisal for impairment testing. We will happily do a fair value appraisal for you in accordance with ASC 820 or IFRS 13. We'll even work with your accountant on this to make sure that we're meeting his or your needs as best we can. Fair value is not fair market value. Fair value is not market value. Fair value is definitely not base value. Fair value is fair value, period. That's really all I've got, okay? An admonishment to not do that again, a definition of what you should be doing instead, and some food for thought. The only goal I had here today was to disturb you I want you to be more detailed the next time you request an appraisal, or at least go home and talk to your accountant about it. I'm not your accountant. I'm not an accountant at all. But if you have questions, I can try to answer them.
Yes, we have a question from Jacques.
Yes, thank you, Sharon. You've been focusing on fair value, but you haven't touched enough market value. Could we remind all of us how to differentiate market value versus fair value?
Okay. Market value or fair market value is defined by the organization that you're doing the appraisal for, typically, or possibly by your professional accrediting society, right? So fair market value or market value is typically unrelated parties, willing buyer, willing seller, plenty of time for the transaction to occur, no compulsion to buy, no compulsion to sell, right? That's pretty common. It's pretty much what we all use under various names. So that's a pretty standard use of, a pretty standard purpose for an appraisal. We do it all the time. So, I mean, we can, if we don't know that you're going for an impairment test, we're not going to think to ask because we don't do that nearly as often. But it's easy enough to do. So the difference is in the exit price scenario and what gets included. It's in the most common market as opposed to the most advantageous market. So small differences, but they could impact the price. Right? It can impact the ultimate value that you end up with. So don't use the wrong one.
Okay, any more questions? Yes, Chris, this microphone's kind of behind you.
I'm a little bit confused. How do you look at an encumbered value?
How do I look at it, what?
Encumbered value as well. So you've got a standalone fair market value or a market value, base values. Do you also look at an encumbered value if you're a lessor, for example?
Oh, like the ISTAT base value? No, not in. You wouldn't do that in an impairment test, right? Because now you have moved outside of IFRS 13. You know, the rules say, and like I said, you don't want to go to jail, and neither do I. So yeah, it's very important to follow the exact regulations as they're laid down by the reporting standards in the country in which you are doing the deal.